Good afternoon, everyone, and welcome to the first professional support webinar of 2021. So great that so many of you could sign up and log in today. Hope you're all feeling nice and positive, sunny outside. What with the announcements yesterday, we can all start making some plans for 2021. I know in my household, we're certainly positive that the schools will be opening in a couple of weeks, so that's something to look forward to. I'm Justin Stevenson, for those of you who don't know me, Tax Investigations Associate Director, RSM. I'm based in the Guildford office and deal with a wide range of clients who have an even wider range of issues with HMRC. I'll hand over to Guy and James in a moment to introduce themselves. Just have a few housekeeping points to clear off first. At the end of the presentations, which should be about 40 minutes or so, I will be hosting a Q&A session, so please use the Q&A box to the right-hand side. You can see at the bottom there. Type in your questions as we go along, and I will ask those to Guy and James at the end. And yeah, and on that note, I think I shall pass over to you guys for your intro.
Justin, thank you very much for that introduction. It's great to see so many familiar faces on the login list. We really do appreciate your time in participating in these sessions. For those of you who don't know me, my name is Guy Jackson and I'm a partner in Restructuring Advisory based in our Guildford office. I've been with RSM since 1998. And during that time, I've also spent 2 years on secondment with the business support units of Lloyds Banking Group and the Bank of Scotland. I'm joined today by James Hawksworth, who's a director in the Restructuring Advisory team, who looks after our Reading, Basingstoke, Swindon and Bristol offices. And prior to joining RSM, James spent 11 years with Deloitte in London. Despite our youthful looks, we've both been working in restructuring and turnaround advisory for in excess of 20 years. And given that we have a much wider audience online than when these are typically done in person, we've just included on this slide some details of the location maps for the restructuring advisory team, just to give you a little bit of flavour for the breadth and coverage of the support that we can provide. So the agenda for today, we've tried to keep this as broad as possible, but and keep the content at quite a high level, but there still is quite a lot to cover, so please do bear with us. The objective really is to provide you with some insight into the current climate and the outlook, but also to share beyond that some warning signs and highlight some of the challenging conversations that may need to be had. And then perhaps also introduce a little bit of an insight into managing the relationship with support banking teams, and then moving on to options for distressed companies. And as Justin has said, we really would encourage your participation in the Q&A session, both at the end of the webinar, or alternatively, if you wish to reach out to any of us afterwards, we'd be delighted to hear from you. And I shall now pass on to James, who will take you through the current climate.
Thanks, guys. So, and thank you to everyone for joining us this afternoon. Guy, if you could just move on to the next slide, that would be great. So, as I'm sure you've seen in the recent headlines, in terms of the status quo, the UK GDP shrank by around 9.9% last year amid the COVID-19 lockdowns. So that impacts on business being the worst reduction in GDP since modern records began, and only beaten by the Great Frost 300 years ago. And really came about due to the country being in strict lockdown at several points this year. And as you can see on the slide, and are probably only too painfully aware, we were locked down from March to July and November to December last year. And this year we've been in lockdown since January. As a consequence, a number of sectors of the economy have been in a deep freeze for 7 of the last 12 months. And that has been driving a huge reduction in GDP. And as you can see on the graph, the reduction in GDP in 2020 is multiple times greater than the GDP reduction that was experienced in 08-09 during the credit crunch. So moving on to the next slide, what exactly has the government done to help with the situation? Well, as you can see, the government has actually done quite a lot. They introduced a bill called the Corporate Insolvency and Governance Act in June last year, which included new tools for helping distressed businesses. These were called a moratorium and a restructuring plan, and these enabled businesses to force an equitable restructuring on their stakeholders if necessary through the court, while gaining protection from creditors. It also introduced ipso facto legislation, which prohibited companies from refusing to supply businesses purely due to an insolvency, moratorium or restructuring plan. And that also assists the restructuring process. It effectively banned winding up petitions during the ongoing pandemic. And finally, it sought to protect directors from wrongful trading allegations. We've then got all of the British bank business lending. It's the coronavirus business interruption loans, CBILs, in various forms. So the government, the British Business Bank, has so far issued or backed lending for CBILs in the amount of 20.8 billion pounds, and has issued bounce back loans to anyone who can pretty much spell their company name in a total amount of around 44.7 billion pounds. And then larger loans in the form of CL bills totaling 5.1 billion pounds. So as I'm sure you know, the C bills and CL bills are 80% government backed, and the bounce back loans are 100% government backed, which demonstrates a huge commitment of public funds to trying to save businesses. So on this next slide, we can see the other protection measures that were put in place, and that includes the hugely successful coronavirus job retention scheme, the CJRS, and that's paid out over 46 billion to nearly 10 million employees. On top of that, we've got the self-employed income support scheme, which is paid out to 6.8 million claimants in the amount of 18.5 billion pounds. Forfeiture restrictions have also been imposed, which bans landlords effectively from being able to forfeit leases where their tenants have failed to pay. And that's resulted in tenants withholding what's estimated to be around about 4.2 billion pounds from their landlords in the form of rent during 2020. Rates relief packages have been in place amounting to around about 11 billion pounds, and VAT deferrals of around about 28 billion pounds had been agreed by the September quarter last year. And the last point on here, the Supreme Court recently gave a very helpful judgment allowing business interruption claims to be made by over 370,000 insurance policy holders, and that will come as a great reassurance to them. So it's clear that a huge amount has been done to date to try to support businesses, but what impact has that had on insolvency levels? So as you can see here, the high street understandably has taken a huge hit over the last year with a number of high profile insolvencies, and we've shown 8 of those here. And with those 8 insolvencies, there's been over 1,700 stores and over 40,000 jobs jeopardized or lost during the last 12 months. However, despite those headline-grabbing numbers, the actual number of insolvencies has been down around 30% lower in 2020 when compared to the previous year, as you can see from this table. The dark blue line shows the number of insolvencies in 2020, and the light blue line is 2019. And as you can see, many companies have taken advantage of the various levers at their disposal in order to avoid their businesses being wound up. So we now move on to our outlook for 2021. Now, economists are being very positive and predicting a return towards normality, which has got to be right. But that will obviously necessarily bring about the easing of reliefs and the need to restructure businesses which have been badly damaged by the deep freeze experienced in the last 12 months. So we think that this will be a year of restructuring, rebuilding and recovery. But alongside that will come the need to provide a lot of support for the many badly impacted but viable businesses. So on this slide, we have a look again at that table showing insolvencies over the last 2 years. And as I mentioned, the dark blue line shows the insolvencies from last year, and the light blue line shows the insolvencies from the year before, for 2019. So if you look at this, you can see that even in a regular year, without the impact of a pandemic, the number of insolvencies should far outstrip what we've seen in 2020, and that's without a pandemic. So that's simply down to the measures we discussed earlier, and therefore there are a large number of companies which should ordinarily have fallen by the wayside and are only surviving due to the legislation which has been passed. So once those measures are relieved, there will be a catch-up on insolvency in those sectors, and the shock of such a surge in numbers is likely to create a wider impact, causing knock-on insolvencies, which you might call the ripple effect. So we mentioned earlier that there's a large amount of debt that's coming onto balance sheet, HMRC debt, rent, and of course the debt that's being advanced by the British Business Bank. And this slide shows you the British Business Bank debt, the CBILs and bounce back loans and CL bills. So the dark green line on this table shows each sector's share of the total loans by value issued by British Business Bank. So the proportion by value of all the loans issued by British Business Bank that's represented by a particular sector. The light green lines shows the proportion of the business population which is represented by that sector. So unsurprisingly, you can see that right at the top, wholesale and retail has needed far more support than the other sectors comparative to its scale, particularly, having received 18% of loans and representing only 9% of business. Accommodation and food service have also unsurprisingly received a disproportionate amount of support, with manufacturing also requiring significant support, having been hit by both the Brexit transition period in addition to the pandemic. And construction has also received a significant level of support and is right up there on the second tier. And construction's been a huge beneficiary of the legislative protections that have been introduced. And that's resulted in the lowest number of construction insolvencies for 20 years. And so that you would expect to also be a sector which might struggle in the coming year as there's that catch up, which I mentioned. So it looks like retail, restaurants, certain accommodation businesses, manufacturing and construction could all be sectors that might particularly struggle next year. So we can now have a look at the potential timing of any difficulty. So in terms of the timing, let's have another look at the slide that I discussed previously with the various reliefs that were introduced. So I've flagged some key dates in green here where protective measures are due to expire or where new legislation is being introduced with unfortunate timing. We've sought to keep these up to date, but it is being updated every day. But when I last checked, these were right. So you can see the prohibition of winding up petitions expires supposedly at the end of March, and that's likely to lead to creditors and possibly HMRC petitioning for the liquidation of companies for non-payment. You can also see that wrongful trading protections for directors expire at the end of April, placing greater pressure on directors to potentially wind up their businesses. And you can see that the British Business Bank backed lending is currently scheduled to cease at the end of March 21, with interest and principal becoming payable for many from 1st of April 21. So there's no confirmation yet of any other government-backed lending schemes being introduced to replace this funding. So for now, it has to be assumed that that's falling away. So we can see on this next slide that the coronavirus job retention scheme is scheduled to expire on the 30th of April. One would hope that something will be introduced in its place, but firms will need to make their plans on the current assumption that it's falling away. The forfeiture restrictions are also due to expire on the 31st of March, and we're hearing from, excuse me, we're hearing from major landlords that they are intending to take quite an aggressive stance in respect of overdue rent, and perhaps that's to get to the front of the queue ahead of HMRC. Rates relief may be falling away later this year, placing additional pressure on cash. And surprisingly, the government is still pushing on with its plans to introduce the domestic reverse charge in the construction sector in just over a week's time, on the 1st of March. So this will mean that a large number of suppliers in that sector will be unable to add VAT to their invoices, therefore causing them to take an immediate cash flow hit at an already extremely difficult time for the sector. So as you may be aware, HMRC was given preferential status in December. Arguably, that triggered a lot of those large-scale insolvencies. And what that means is on an insolvency, HMRC not only get paid ahead of regular unsecured trade creditors, but it also gets paid ahead of floating charge lenders. So any bank or funder lending that isn't secured on property or debts with a fixed charge, if they're not secured on that, then their lending will be a little bit riskier, and therefore it will be priced a little bit more highly, be a little bit more expensive, and it will probably be a little less available in the market. So not good timing for that. The same legislation that gave HMRC preferential status also gave them the power to make directors personally liable for up to 5 years of taxes if they are involved with a third insolvent entity, either as a director or a shareholder. So that's really going to be cause for concern for some individuals. And finally, Brexit. Brexit is obviously also going to cause some cash flow issues for a number of businesses in the medium term, possibly due to significant cash cost and delay with supply. There are a number of challenges arising around Brexit, and I won't go into detail of any of them, but an example might be that companies in the UK that are importing product may be deem it necessary to hold greater amounts of stock in the UK in light of potential delays in getting stock across the border. And equally, companies in the UK that are exporting to mainland Europe may look to hold additional stock across the border to be able to meet customer demand in short order to compensate for potential delays. And all of that has got a cash impact. There'll also be considerations around origin of goods and potential tariffs where goods are comprised of components which were sourced from outside of Europe, alongside many other tax implications, which it appears that many companies who have been busy battling the pandemic may not yet be quite ready for. So in summary, I return to the point, which is a positive point, and apologies amidst all this doom and gloom. The positive point here is that 2021 will see the beginning of the recovery and businesses trying to bounce back. But in light of that recovery, the government will end up hopefully gradually reducing the protections, which will mean a large number of businesses with a large amount of loans, HMRC debt, unpaid rent or similar, will need professional support and advice to navigate their way through the coming year. We do think that insolvencies are likely to double in the 12 months after the release of government support, with the turning point currently looking like April to June, but entirely dependent on any extensions or new initiatives the government might implement. A large number of these insolvencies will be driven by businesses, by viable businesses, which just can't accommodate the amount of debt in their balance sheet. And therefore, a lot of these balance sheets will hopefully be restructured consensually or via a company voluntary arrangement or restructuring plan prior to insolvency. Alternatively, the underlying businesses might be saved out of insolvency, possibly via a pre-pack administration. So a number of sectors may be particularly impacted, as I mentioned, and as you can see here. But early action and clear stakeholder communication will hopefully mean that companies can be restructured without the need for an insolvency. So an important part of this will be identifying clients in difficulty as early as possible by being aware of the warning signs. And in the next section, we will talk you through some of these warning signs, the implications for directors of not acting, and how to initiate difficult conversations around restructuring. So it will be extremely important to be alive to the warning signs of distress, a number of which are covered on the slide, and I'm only going to mention a few of these. An awareness of the sectors I mentioned previously will be key, and an awareness of the levels of debt, which will be coming onto the balance sheet of many companies, will also be fundamentally important to spotting distress. There will be businesses in impacted sectors which will struggle to recover book debts and hit sales targets due to the pandemic and Brexit. And that's going to stretch their working capital cycles and cause them to underperform. In terms of more generic warning signs, we flag on this slide that a loss of key staff can severely impact a business and trigger a downturn in performance, as can a change in legislation, such as the domestic reverse charge and Brexit tariffs. As a business becomes more distressed, you may become aware of bank facility breaches. And as insolvencies increase, your clients may become impacted by loss of key customers or loss of suppliers. A key indicator of a company tipping over into crisis point can be the withdrawal of credit insurance, receipt of legal letters from stakeholders, and obviously COVID-related lockdowns impacting their primary market. So these are a number of clear warning signs for businesses. And the next slide just touches on the need to move quickly. So early intervention is absolutely key. And you can see on this decline curve, and apologies teaching you to suck eggs, but without intervention, the available options reduce as time passes, and the situation moves from underperformance through past distress and into crisis, and ultimately into the company's insolvency. And matters then being outside of management's control. So the earlier we are introduced, the more solutions remain available, the greater the support of stakeholders, and the more likely that an insolvency will be avoided. And we'll go into more detail about the options for supporting these businesses later. So a key factor driving the decision-making of directors at this time will be their legal duties as a director. So once a company becomes insolvent, either by having more liabilities than assets or being unable to pay their debts as they fall due, the duty of the directors switches from prioritising shareholders and the companies to prioritising creditors. They must consider and act in the interest of the creditors in order to minimise the potential loss to them. If the director breaches these duties, they can be personally liable for losses and face disqualification from acting as a director for up to 15 years. So in terms of the key risks for directors, what do they look like? Well, directors will no longer be protected from wrongful trading after the 1st of May. They will be liable for selling assets for less than they are worth, and that's a transaction at undervalue. They'll be liable for paying one creditor in preference to another creditor without appropriate justification. Or they could be liable for misfeasance by misapplying company funds and unnecessarily causing loss to creditors. And as mentioned earlier, directors and shareholders can now become personally liable for up to 5 years of HMRC liabilities in some circumstances. Therefore, as soon as directors become aware that a company may be insolvent, it is absolutely in their interest to be introduced to and obtain professional advice from a turnaround advisor such as Guy and I. So what are the key facts to highlight when introducing a conversation about restructuring to a client? I mean, previous times it was always more difficult to introduce these conversations, but in the current climate, there's so many companies who experience unheard of difficulties, it should be a little easier. We've mentioned personal liability, and this should be at the forefront of the directors' minds. And in respect of directors' duties, lining up an initial meeting with insolvency practitioners like Guy and I will cost nothing, but minuting that meeting will help to justify directors' actions should they become challenged in the future. We earlier mentioned the ripple effect and the uncertainty that is likely to arise from an environment where there are likely to be a large number of insolvencies. And this helps to emphasise to a director how important it is for considered contingency planning to take place, given the unstable and unpredictable environment. It's worth remembering that carrying out that planning at an early stage will preserve value and protect goodwill with the stakeholders who may well be needed when it comes to implementing a lasting solution. And finally, owners and managers of these businesses with badly damaged balance sheets and heavily leveraged balance sheets will be aware that they need to trade successfully for a good number of years before they will be able to generate enough profits to pay back the debts on the balance sheet and be able to begin receiving a dividend in the business's current form. Therefore, it's in all parties' interests to stabilise a badly damaged business, restructure the balance sheet, and put it on a stronger footing to emerge successfully from the other side of the pandemic. So we've looked at the situation from the perspective of the advisor and the client, and Guy is now going to talk you through the way the bank's specialist support teams may approach matters.
Thank you, James. Yes, I think it's important to acknowledge here that in situations of distress, the banks do have their approach, and they do have dedicated business support teams who are primary purpose is to look after customers who are experiencing financial distress. We're certainly seeing an expectation there'll be increased activity in that area of the bank's operations, and I think that is a view that is shared by the banks. And through our kind of membership of the bank's restructuring advisory panels, we have a close relationship with those business support teams, but we are seeing a subtle difference in the way those teams are working. Historically, those dedicated teams, the entire relationship with your client may be handed over to those teams. The business support managers had smaller portfolios, which allowed them to have increased client contact. With it came increased reporting requirements to the bank, and also an emphasis on your clients and the bank's customers having additional professional support, as well as obtaining formal reviews on insolvency restructuring options, and also being subject to shorter funding cycles in their facilities. However, we are actually seeing a change in the way the banks utilise their business support team. The revised approach here, the primary change is that it's now two-pronged. Either the relationship is handed over to the business support team in its entirety, or it continues to be maintained by the existing relationship team with some additional support provided by the bank's business support team, almost an overlay of additional support. And as a consequence, the business support managers now have a split role between looking after their own portfolio and assisting the mainstream relationship managers. And actually, we believe there will be a material difference in the way in which these relationships are managed. And we believe that a proactive engagement with the bank can have a bearing on which approach is taken. So actually, whilst it's largely down to your client to be proactive, we would always encourage you to support them in being proactive and engaging with the bank to try and have a degree of control over that relationship. Now, drilling down into the areas where you can support your clients. First there, hand-holding and a proactive approach. Well, that's obvious, but it is important. And the key is to adopt that approach from the outset in terms of building that relationship. The other element is leveraging your role. The banks will take comfort from your involvement with your clients and your clients receiving professional support. And also being aware of the additional reporting requirements that will be placed on your clients, because they will be looking to you to provide much of that additional support. And I think the key here is to have the conversation and to understand the bank's additional information requirements. Specialist support is also vital when the bank's business support teams become involved. We typically find that the involvement of specialist support assists with bank communications, provides a high degree of credibility with the banks, and helps maintain existing advisor relationships, because what it does is avoids the introduction of additional sort of panel firms. Also, the additional support that is provided by specialists takes care of some of the specialist requirements, such as independent business reviews and options analysis. So if we look at the options for distressed companies, and moving on to those, and again, I sort of refer back to the decline curve previously mentioned by James, because it's helpful to understand how the range of options change as a business becomes more distressed. The key messages with this really are: more options exist the further up the decline curve you are, and as companies become more distressed, options become more limited. The same is also true of your involvement and ours. There are more opportunities for to assist your clients earlier on the decline curve. So the takeaway from this would be to act early. The importance of managing stakeholder relationships is common to all of the options. Certainly, if I take a step back and look at the range of support we provide, it is closely aligned with the curve. We also find that sector knowledge is extremely important to help your clients understand what the implications are of their position on that curve, and most importantly, their direction of travel along the curve. And James will now look at some of these options in a little more detail.
Thank you for that. So, as has become clear, a key focus here is that we want to move quickly to ensure we can get a clear understanding of the business and its stakeholders in order to be able to negotiate a solution which can win the support of the key stakeholders. So we've sketched out here just some of the key actions which we tend to take in order to assess the options available to a company in distress. The first step will be to have a clear understanding of the business and the key individuals involved with the business, and those individuals' short and medium-term expectations and goals for the business. We then need to get our arms around the financial information, analyse the cash flow and the balance sheet, identify the working capital need for the foreseeable future, and the business's longer-term profitability as it comes out of the other side of the pandemic. This will all help us to identify the company's key stakeholders, which will potentially include key suppliers, funders, customers, HMRC, and possibly even pension trustees. So there are going to be a lot of players connected to the business that are going to have a significant interest in making sure that the company avoids insolvency. Understanding who they are and what role they can play in a solution will be pivotal to finding a credible solution. As part of the process, we will also try to identify any easy wins, such as capital allowances, tax refunds, credits, government reliefs, etc. And at this point, I should say that you may well have already done this exercise for your client, or be equipped to do it yourselves, in which case we would always prioritise working with the existing advisors and only undertake additional work where it was absolutely necessary. So once we've mapped out the key areas, we'll be equipped to evaluate the key contingency planning options. And these options will usually prioritise a consensual restructuring. And we will look to forge a solution without an insolvency. However, we also have a restructuring plan in our toolkit if it becomes necessary to force an equitable solution on stakeholders, or we can use a company voluntary arrangement. or even use a pre-pack potentially to save the underlying business. And we'll come on to talk to that a little later. But the primary goal in this, in most situations, will be to achieve a restructuring consensually, and we will look at that process on the next slide. So a consensual restructuring is our primary option where the underlying business model is sound and there is a very strong potential to revive the business post deep freeze as we come out of the other side of the pandemic. So this will help to preserve value, and it's the least disruptive option for a business. And what we seek to do is identify a solution which will unite stakeholders under the common aim of avoiding a nuclear insolvency option, which would inevitably render a worse result for everyone. Therefore, a crucial part of this is to be able to communicate to the key stakeholders exactly what that nuclear option looks like and how we would execute it should it become necessary. And we're able to do that by virtue of the work we've done and discussed on the previous slide. So this process does not require an insolvency and therefore minimizes the disruption to the business, minimizes any loss of goodwill and minimizes costs. It includes the key stakeholders as a part of the solution and therefore maximizes goodwill with them. And that's obviously a very important aspect of helping the business return to profitability when it emerges from the other side. And because the process is a confidential process, it minimizes negative publicity. However, a consensual process does need excellent levels of communication and diplomacy and relies on a strong degree of trust. And therefore, it requires careful planning to ensure that communications are clear, credible, and consistent, and stakeholder buy-in is therefore maximised. So we've included some simple examples here of how key stakeholders can support a restructuring. We mentioned funders and creditors, potentially granting some forbearance or writing off parts of their debt. Private equity houses might be required to convert loan notes to equity in order to repair the balance sheet. And management may be looked at to inject funds in exchange for equity to demonstrate their long-term commitment to the business. And if all parties can be kept on board, this is a hugely attractive option. But there will be some situations, unfortunately, where this simply isn't possible, possibly because we've been involved too far down the decline curve and there isn't enough time or value remaining within the business to communicate a workable solution to the various stakeholders. And in those situations, other options may need to be implemented. So over to you, Guy.
As James has outlined, where a consensual restructuring is not possible, other options do have to be considered. And I think the importance with this is that these options we're looking at now represent business rescue options. So that is a primary objective. In the first box there, we have the CBIL restructuring plan and moratorium previously mentioned by James, where the fraudulent insolvency can be avoided and the court can impose an equitable solution on stakeholders, even if they vote against the proposal. This was used by Virgin Atlantic recently and Pizza Express. And our view is that these will become more common, notwithstanding the current examples being to the larger corporates. Also is the CBIL moratorium, which will provide temporary protection from creditors to allow restructuring to take place. There've only been 4 such examples thus far, and one of those has failed. Moving on to perhaps the more established and well-known processes, there is the company voluntary arrangement, the CVA. There's lots of press recently about this in both the retail and casual dining sectors. And this is a formal compromise of amounts owed, both in time and quantum. So really what we're talking about here is XP in the pound over X number of years. Obviously, broadly, this requires a 75% vote in favour from the creditors, and that is binding on secured creditors. An alternative is administration. And this is another established, well-known process. It's a very powerful process focusing on business rescue, typically when linked to a prepackaged sale of the business or a trading sale. The objective being to preserve the maximum value for creditors by preserving the business as a going concern. Administrators have a very broad duty of care to act in the interests of all creditors. Now, where the situation is perhaps more terminal, there are 2 primary options. Again, administration, but in this scenario, it's in conjunction with the closure of the business and a sale of the assets on a forced sale basis. And alternatively, liquidations. 3 primary forms: the creditor's voluntary liquidation, the CBIL, the compulsory liquidation, and the provisional liquidation. Now, despite the recent changes in insolvency legislation, a liquidation remains very similar with the creditor-driven close-down process with which you will be familiar. So one thing in common to all of the options outlined today is collaboration. So it's entirely appropriate that we have a mix of lawyers, accountants and funders on this webinar. And the benefits of navigating the decline curve will be far-reaching for all involved. For the lawyers and accountants, the successful outcome will preserve your client and potentially generate additional work for you as part of the process of doing so. For funders, the successful outcome will avoid the prospect of losing a customer and maximising your chances of recovery. We've outlined a few of the examples of the potential areas you can provide assistance to your clients on this slide. And as you will see, these are very wide-ranging. Many of the examples go beyond the ongoing support you typically provide on a day-to-day basis and reflect the challenges faced by your clients. And whilst many of the challenges associated with working with distressed companies, particularly where steps have not been taken to mitigate those challenges at an early stage, one of the most rewarding aspects is the work we do with you to support your clients. My one takeaway would be to encourage early dialogue. There is often a huge value in a quick call to share thoughts. I shall now hand over to James, who will share a recent war story.
Thank you, Guy. So I'll briefly talk you through a practical example of us supporting a client which we were referred to by its legal advisors in October last year. So we were asked to help a small group of gyms which were operating across the south of England. As you can imagine, by October last year, they'd been badly hit by the lockdown, and membership numbers and turnover were significantly down. So they'd recently been granted a CBIL loan and had a very healthy cash balance in their bank account. But despite this, management couldn't see a way to return to profitability with the uncertain impact of the pandemic and the potential for future lockdowns. So we spoke directly to them, and we reviewed each of their gyms. We helped management to produce projections and identified the funding requirement on a site-by-site basis and the forbearance required by landlords to settle the significant rent arrears that had accumulated by that point. We also helped them to identify the required level of rent negotiations for each site in order to for the rent to be at a level which would enable the business to return to profitability going forward. So given the uncertain trading environment and potential for future lockdowns, we concluded that turnover-based rents would be necessary to provide the group sufficient flexibility to survive the coming year. We recognise that some landlords might not feel able to agree the level of rent reduction we were asking for, and so we also identified settlement proposals for those sites. So having identified a flexible, solvent solution, we analysed the outcome of an insolvent solution, the nuclear option, which unfortunately rendered a very poor return for all creditors. So we were then equipped to reach out to the bank and to the landlords to negotiate and communicate the proposed solution and to set out the alternative nuclear insolvency scenario. All but one landlord and the bank accepted the proposal. So the bank had confidence in us through our previous relations and how we communicated the information. All the landlords, except for one, also believed in what was being put forward. And one landlord was holding out, which we believe purely to be a negotiating tactic. So in addition to that, well, part of the way through the negotiations, lockdown 2 occurred, which further complicated matters. But by that time, we'd gained sufficient buy-in from the other landlords that I mentioned and the bank to enable the company and us to propose and comfortably gain 99% approval from creditors for a company voluntary arrangement solution. And that solution effectively imposed a settlement on the obstructive landlord. And we structured the CVA contributions in such a way that despite the bank having recently advanced quite a substantial loan, they felt able to support the proposal. So I'm pleased to say that that company is continuing to comfortably ride out lockdown 3 as far as anybody can ride out lockdown 3, and is looking forward to opening up again in April. So this is an example of how the process we follow, the experience we have with landlords, and our strong relationship with the banks have combined to enable us to save a business which would almost definitely otherwise have failed. So finally, let's summarise a few of the key points which we have touched on during the presentation today. So sadly, we do expect to see a doubling of insolvencies over the 12 months following the government withdrawing the various lines of support. We feel that the ripple effect of those insolvencies is likely to impact some sectors and clients which may otherwise have considered themselves to be insulated from the impact of the pandemic. Key to the timing is going to be the government's approach to future relief and tax forbearance. We would hope that the government will introduce new legislation to cushion the flow of insolvencies, but as yet, none of that's been announced. So people need to plan for the potential cliff edge of April, May, June time. We flagged that a helpful tool to introduce restructuring into conversations with directors are the owner's expectations of achieving future dividends and the director's duties and risk of personal liability. And the overriding message really is that early engagement with advisors is key to achieving a consensual solution and restructuring the business in the best interests of all the stakeholders. And that it is essential to do the groundwork to enable clear, consistent and credible communication with the stakeholders to get them on board as early as possible. So if all of that can be achieved, then your client will be best placed to achieve a long-term, flexible solution which enjoys ongoing stakeholder support and enables them to take full advantage of the recovery we're anticipating following the pandemic. So thank you all very much for listening to us this afternoon, and we would welcome any questions.
Thanks, James, and thanks, Guy. Certainly very interesting, and I'd say perfectly well timed with clients and conversations going to be having in the next couple of weeks, sort of planning their way out of the lockdown situation. We've had a few questions through, which I will put to you now, but please do take a minute to jot down any other questions you've got, because we should have time to cover them all. First question is for you, Guy. Have you seen the banks increasing the size of their support teams in anticipation for increased volumes of distress?
Simple answer to that is yes, but in two slightly differing ways. In some scenarios, we have seen them increase headcount, certainly the banks, but in other scenarios, what we've seen them do is to try and increase coverage of their existing teams by that overlay with the mainstream relationship managers. So this is to say that the business support managers will now have a greater exposure, albeit on a slightly less condensed, slightly less intensive basis, to a wider selection of the bank's clients. So really, that's the two ways in which we've seen that done.
Excellent. And linked to that, I guess, Guy, you mentioned that banks have a panel. Does this mean that if my client moves into a business support, the bank will encourage the client to replace me as their accountant?
So in that scenario, yes, I think that's slightly different context. What we're talking about panel there is typically the banks would have a restructuring advisory panel. So that would apply in relation to advisors that they would look to bring in to provide the insolvency and restructuring support. What banks would not look to do is look to encourage their clients to typically change their accounting relationships. In fact, it's extremely important from a continuity perspective and ensuring that the right information is provided to the banks in a timely manner, that actually, as far as possible, those existing accounting relationships are maintained rather than replaced.
I'm still on mute. Thanks for that, Guy. And James, I believe this next one is for you. You mentioned moratorium and restructuring plans being introduced by the government. How often do you think these will be used, and are they effective?
So this legislation came in June, late June last year. They haven't been used very much to date. I think, as with most of these things, the the existing legislation is very well established, and so that's been people's go-to, advisors' go-to really. But there have been 4 moratorium used so far on very, very simple businesses to allow for bridging finance to be brought in. One of those moratoria failed. So again, it doesn't suggest that that's been really taken advantage of as much as it could have been, and it can be quite an onerous process. Restructuring plans, I think there's been 4 of those as well to date. Virgin Atlantic, Pizza Express, Deep Ocean and Gate Group, I think, are the 4 that have been used to date. All of those businesses, very large businesses, but we've already started to use restructuring plans in our contingency planning. And I think that they will be used more and more often for mid-level, mid-tier businesses, because I think the cost of these processes is going to come down and down. But it can be used very effectively to help apply leverage in discussions with stakeholders, because a restructuring plan can even be used to compromise a shareholder position. If there's a shareholder that's demonstrably out of the money, then they can be compromised away from the company if it can be presented to the court that the solution being proposed is equitable and results in a better result for the stakeholders than the next best alternative. So I do think it's something that hasn't been used a lot to date, but I do think the use of them will increase, and we'll see them more and more for sort of medium-sized businesses over the coming year.
Thank you, James. I guess this last one, or this next one, is for either of you. What is HMRC's attitude at the moment? Are they being very aggressive? I assume that means in terms of a creditor.
I'm happy to take this. They've actually been fairly helpful, actually. It all comes down to being able to communicate a credible plan and a credible turnaround. The last thing that they want to be seen as is being used as a bank. So they want to know that the company has really, looked down the back of the sofa, under the kitchen seat, everything else to try and find funding, and are only going to HMRC as an absolute last resort. And if you're able to communicate that to them and communicate a credible return on the other side, then they will be open to quite flexible proposals. Indeed, we had a proposal agreed not so long ago where we weren't able to tell HMRC the exact timing and quantum of payments that they would receive. We were simply able to demonstrate to them that there would be a turnaround and give the shape of that turnaround. And HMRC were agreeable to that. So I think they are looking to work with the turnaround advisors, but only time will tell the level to which they're prepared to waive any of the amounts outstanding over the coming 12 months. So we've got very good relationships at HMRC with some of the key people in the coronavirus team at HMRC. So we try to keep close to them and understand exactly what they're looking for in any of these sort of compromise communications.
Thanks, James. I've got a slightly different question here. As a HR consultant, I'm interested to know at what point you assess the people aspects of the business. Either one of you want to pick that up?
I'm happy to take that. As soon as possible is the answer. Obviously, the sort of employees are an absolute key stakeholder in the business, both as regards their own positions, but also as regards preserving the business as a going concern. Often that is the know-how, and it becomes a very important aspect. But also there is quite a lot of sort of legal aspects for consideration on that as well. So in addition to considering that aspect, we would always be recommending that the company takes specific advice in relation to its employees and staffing matters, whether that be from their existing advisors or whether they need to take additional HR support given the circumstances they're facing. Quite often, if a business is looking to be sold as a going concern, it's one of the first areas that any purchaser will be interested in. So ensuring that everything is in order and the value that exists, the know-how, the knowledge within the employees is preserved is a key component in virtually all restructuring options. That's a very interesting question. Thank you.
Thanks, Guy. I think we've got the last question here then. Are you seeing many solvent liquidations to take advantage of pre-budget day, presumably in a potential increase in CGT, I guess?
Yeah, we are, Justin. We're seeing quite a big uptick in that. People concerned that, as you say, CGT will move to be more in line perhaps with income tax. We really don't know that will be done. To many, it's counterintuitive at a time when they're trying to stimulate the economy, but we've certainly seen an uptick in that. And speaking to our corporate finance guys, they've seen an uptick in transactions as well, looking to affect transactions for similar reasons.
Thank you for that. We've had one more come through as you were answering. I assume this is also for you, James. You've suggested that the construction sector has taken a great hit due to COVID. However, as I recall, construction was one of the few sectors allowed to operate through the lockdown. How is it that they've been hit so badly?
I think my focus on this was really that construction, the level of insolvencies in construction have been greatly diminished by the legislation that's been put forward. So as I said, the number of construction insolvencies last year is the lowest number of insolvencies for over a 20-year period. And so what that suggests is not perhaps that they've been disproportionately hit by the pandemic, but that certainly there's going to need to be an adjustment with that. There'll be a lot of construction businesses in the normal course of businesses would have fallen by the wayside, and those insolvencies are highly likely to catch up in 2021. And as I think you may have seen as well from the debt slide showing which companies have taken out business interruption loans, construction was the second in the list there as well. So that suggests an element of distress on that side of things. But absolutely right, it would have been far worse had they been required to cease trading entirely in that period.
Thank you very much, both of you, and for everyone who asked a question. And also, again, thank you for joining us. Certainly was an interesting session and some good questions there at the end, keeping James and Guy on their toes. So I always like to see that. So the next thing for me to say is please join us for our next event, which is in a month's time on the 23rd of March. I'll be joined by some VAT and customs colleagues who will be talking about Brexit related matters and origins of supply. So again, it's a very topical area for everyone, I'm sure. And please do, if you haven't already done so, update your preferences on the slide here. And thank you very much, and I'll speak to you soon.